Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, August 28th, 2021. And our top story this week, investor familiarity remains low for sustainable investing. Well, joining me now to discuss this and a lot more is Lydia Saad. She's Director of Social Research at Gallup. Lydia, it's great to see you. Thanks so much for joining us on the program this morning.
Delighted. Thank you.
Yeah, this is great. I obviously a big fan, big consumer of Gallup research and polling and information. And you conducted some research on how investors view and understand sustainability. This is a hot topic, as we were talking about before we went on the air. What can you tell us about how people understand it, or whether they do or don't understand this topic?
Sure. So we can talk about that on two levels. In terms of investors, Gallup does a survey of U.S. investors every quarter, and we define this as average, Americans 18 and older who have $10,000 or more invested in stocks, bonds, mutual funds, either within or outside a retirement account. So there's a pretty high threshold. It scoops in about 40% of Americans meet that threshold. And so we've asked them periodically about sustainable investing, their awareness of it, their interest in it, their use of it. And we just updated that. So that survey that we, oh, sorry.
No, go ahead. I was going to ask you, in terms of the meat and potatoes of it, are there groups of the population that you looked at that according to this, 1 in 4 U.S. investors have heard of sustainability. 25%, probably not a great number, but within that number, is there a population, maybe younger people or mature people, who have a better understanding about it?
So familiarity tends to follow education. So college graduates, we've got about 50% of investors who are college graduates have heard of it, drops to like 38% among people with some college, and then below 20% with those with no college. Doesn't really run with age among investors, because here you're dealing with people who already have the wherewithal financially and probably educationally to be at the 10,000 level. So we don't see a big difference in familiarity by age. We do by education.
Yeah, and as we were talking, the institutional marketplace, you hear a lot about sustainability, ethical investing, ESG. Every pension fund, at least a public pension fund, heavily invests in, not heavily, but they have an allocation towards sustainability. And you're hearing about it from a corporate governance perspective. But in terms of familiarity, it just seems like it hasn't really permeated the public consciousness yet in the way that it has on the institutional side.
That's correct. And really, we were struck that it didn't move at all in the past year and a half, when there's just been a lot more buzz about it. If you just Google it, you'll just see a lot more returns coming up, as you know, in the last year than even prior to that, with the new SEC now looking at implementing disclosure regulations around ESG. But it seems to be more at a higher level. It's not trickling down to the average public. We haven't seen an increase in awareness among investors over the last year and a half of ESG. And I just want to say we are defining it very broadly. We're giving them all the words. This is a web panel survey, so it's written. People are doing it online. And we tell them all the different ways that this is described. We're asking them about sustainable investing, which can mean ESG, responsible investing, social impact investing. Even with all that, they're like, it's kind of know what you mean.
Well, do you think some of this is just like, we're in the throes of a pandemic? There are other financial concerns that many people have, many real Americans have, whether maybe they lost their job, they had their hours reduced, maybe they had a family member afflicted with COVID, they've had some other health issues. Could it just be that this is not the top issue for people, and that mitigating the risks of the pandemic and dealing with all these other issues are really just top of mind right now? Could that be it, and maybe a lack of knowledge is not really...
I think that could be part of it. I think also you cannot overstate the amount of information out there, the amount of news, and breaking through to the public is very difficult without, being on the network news. And so a lot of times this information is in very niche publications and financial publications and business things, the Wall Street Journal, things the average American, not even the average investor, is reading. So I just don't think it's the places they're looking. And we also looked at it by whether or not people have a personal financial advisor, thinking those folks probably will be more familiar and interested in it than others, and they're not. We know this from past research we've done on it, that people are not hearing about ESG from their personal financial advisors. So
that is so interesting to me. If I hire a financial advisor, I'll just give you my opinion, and you can tell me if I'm wrong or right. If I hire a financial advisor, I want to know about all my options, whether it's exchange traded funds, sustainable investing, annuities, how I'm going to generate retirement income. That seems to be a big theme in the retirement industry that they're talking about. So I just find it kind of odd that the financial advisor wouldn't bring this up, but maybe it's only for the higher end, the ultra wealthy, the family offices, multi-generational offices.
I think you're right. I think from my reading of what's happening is you have a lot of institutional funds, including this ESG components. Again, it hasn't trickled down to the consumer level yet. And that's why we're tracking it. We're waiting kind of to see that happen. But you talk about the reasons why these funds exist and that people are interested in them. And certainly the components are interesting to investors. They care about the environment. They care about worker treatment of workers. They care about corporate governance, good ethics, transparency, and they care about diversity and equity. So they say those things impact their consumer decisions. They say those things impact their choices of stocks and so forth. So these things may be creeping into their portfolios, but they're not aware of this broader framework that it all falls under.
Yeah, and I think my personal opinion is I think continued education. I mean, that's what this network is about, and I know that's why you guys put information out at Gallup. It's continuous information, education about important topics. One thing I found really interesting was, I was reading the report that you all generated, and it said investors expect sustainable investment returns to follow the market average. That's interesting to me because, kind of growing up in this industry, there was an expectation that if you benchmarked against the S&P 500, which is a common benchmark to do so, you'd always have a lag because of that screen. Did that strike you as kind of interesting? Like, hey, we should get the same market average regardless of if we're in a sustainable investment or ethical investment versus a traditional index.
Yeah, I viewed that as you can see a glass half full or empty, but I think I viewed that as a positive, that people don't see these as a mercy purchase. Like, I'm doing this for the greater good, but against my own interests. You have 70% saying these funds perform at par with the market average, and 5% think they perform better. So 3/4 are not disincentivized from, a returns perspective from looking at these funds. And I know there's all different ways to analyze whether or not they do or don't perform better. But I think long term, that argument that you're minimizing risk when you're looking at companies that are being sustainable and not getting into ethical trouble and attracting employees with, low turnover, those things should help investment returns, long term. That's where the financial advisors really come into play to help explain that to investors. But as we say, it's not really happening yet.
Yeah, and I think your perspective is a lot. Maybe that is the proper way of thinking about it, which is it's actually a positive. People don't see a difference, so why? If there's not a difference, why not do it? Let's talk about future research and what we could be looking for from Gallup on this topic. I know you said you've attacked this concept before. You continuously look for how it permeates the culture, how it's embedded in the ethos of investors. What can we expect in terms of research in the future?
So as I said, we track investors quarterly. I think going forward, because there's not a lot of movement on this, it's not something we need to update frequently, but I could see at least once a year dipping back in and finding out if there's been any change in people's awareness and interest in it. And then as, let's say the SEC does come out with specific guidelines for companies to report, we'll probably get investor reaction to any public policy in this area.
Yeah, and I think we can expect, I mean, just anecdotally, just reading things out of your periodical and others, the SEC heavily honed in on this, and there's that term greenwashing that is basically people just saying that they're sustainable, or they follow ESG, or they follow these rules to pick investments, but they're not really doing it. I think this gets a lot more attention from the regulators, and therefore, because it gets attention, it gets more constraints around it, makes it even more acceptable of an investment. Would that be something you might think investors would agree with?
Yeah, absolutely. There have to be reliable metrics about what these things mean, and it has to be, uniform across companies. They can't pick and choose and define things every which way. And Gallup's very involved in looking at how to create standard metrics on the human capital side of things, because Gallup's an expert in, employee engagement and all these different things. So the more there can be standardization of metrics across companies, the better for the consumer.
Yeah, absolutely. The more you can compare and contrast, the better off you're going to be as a buyer. Lydia, we're going to have to leave it there. We're not doing this survey enough justice. People can certainly check it out online on the Gallup website. Great to see you. Thanks so much for joining us, and we look forward to having you and the Gallup team back again very soon.
Thank you so much for having us.
Thanks, Lydia. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Thursday, we sat down with the Institute of Student Loan Advisors, Betsy Mayotte, to discuss rethinking taking that student loan. Let's take a look.
I keep saying the hits keep coming with under the current administration. They seem to be doing whatever they can to make it easier for especially the most vulnerable borrowers to get the relief they need. And the latest is with totally and permanently disabled borrowers. So if you're someone who's unable to work due to injury or illness, and that's anticipated to go on for 5 consecutive years, then you've always been able to apply for discharge. However, there's a category of borrowers who are receiving Social Security disability under the 5 to 7 year review period. Now, what that means is that Social Security only requires you to re-up your eligibility every 5 to 7 years. Some people get reviewed every year, some people get reviewed every 2, but for those that are considered the most permanently disabled, you only have to do it every 5 to 7. So what the department has done is, instead of making those people apply, they're connecting with Social Security, comparing those people on that list with those with federal student loans, and automatically discharging their loans so they don't have to go through the process, which is huge. If you're eligible under this category, and there's multiple ways to be eligible for total and permanent disability discharge, but this change mostly affects those that would apply under that SSDI status. So if you are under that SSDI status, then you should expect to receive some sort of correspondence about this by the end of the year. They said they were going to get started in September. Now, the other thing that they're doing is, for the other way you can get disability discharge is if your doctor certifies that you're disabled. That's sort of the old school way. But for those borrowers and those applying under SSDI, there was this 3-year monitoring period where you'd be required to submit proof of income for 3 years. And the reason they did that is to avoid fraud. If you say that you're disabled and you can't work, therefore you can't pay your loans, it might pose some questions if the year after your loans are discharged, your income is, $60,000. The problem with that is that more than half of borrowers were neglecting to respond to those letters and were getting their loans reinstated. So the other thing the Biden administration did is they've eliminated that requirement that you submit proof of income for the 3 years. So that should make things a lot easier for these borrowers that need the relief. For the past 2 months or so, I've been thinking that they were going to extend the COVID waivers. And I did think they would do it to the end of January. They made it clear in this announcement that this is it. Unless something enormous happens, this is going to be the last extension. So I think it was smart, considering all the other balls that are in the air this fall, most in particular, the fact that Fed Loan Servicing and Granite State, another student loan servicer, have announced that they're not renewing their contracts. So that's about 10 million accounts that need to be transferred to new servicers. We also have a negotiated rulemaking this fall. So the Department of Ed has a lot of really complicated issues on their plates. And so I think extending the waiver to the end of January just gives the Department of Ed and borrowers and the student loan servicers more time to prepare for the faucet to get turned back on. I think the most important thing to think about is once school is over, whether the amount of debt is going to be affordable. I mean, you need to be thinking way ahead and not thinking so much as far as what the big number is going to be, but more importantly, what the monthly payment amount is going to be.
And on Friday, we spoke with Scholarship Gold's Elizabeth Hartley about prepping high school juniors and seniors for the college admissions process. Let's take a look.
In some ways, it's changed for the better. So like to your point, a lot of schools did have to go lockdown and not do in-person tours, but it forced the schools to create better avenues for kids to do virtual tours, and not just pre-recorded ones, but synchronous tours with real people. And the benefit of that is not just in they get to see the campus, but also it creates a record of that student engaging with the college. And colleges, many of them, not all of them, do track a student's demonstrated interest in them. So they would track, have you been on our campus for a tour? But they wouldn't track if you had done a video tour. Now those virtual tours are counting as demonstrated interest, because colleges want to admit kids who have shown an interest in them. They want to say yes to kids who are going to say yes back. So it has really forced them to create more virtual opportunities to kids who might be geographically unavailable. So that's been a good thing. It did create some havoc when all of the schools went test optional, because the SAT and ACTs were just canceled across the board month after month after month. And even though the SAT and ACTs are not a predictor of success in college, it was still the only kind of universal yardstick that colleges could lean on to measure kids from different states and demographics and public schools, private schools. So it still served a purpose. It really did force schools to have to be more holistic. And our guidance of our students, because we start with kids so early, we said still go ahead and try to do the best you can on the test. And if it works well for you, then we'll use it. If not, then we won't. And that strategy seemed to work really well. So our biggest impact with COVID is just on kids' grades, because some students did find their schools pivoted to remote learning really well, and the students just did well. Some schools struggled with that, but also emotionally, kids struggled with the isolation, staring at a screen so much, and their grades suffered. So that's the negative impact, is a lot of these kids are having to kind of make a comeback, rally in the fourth quarter, basically, to become the students they used to be now that they're largely back in school. So it's been a real mixed bag. And I was the same way as you. We met with the counselor, picked a couple schools, took the SAT once, got into school. And now that's very different, because the cost of college has gone up over 1,100% since the late 80s. And that's far more of a increase than we saw in salaries or anything. So it's now much more sacrificial for a family to spend the sticker price to send a kid to college. So we have to be more thoughtful in advance of how do we still want our kids educated, because there's a lot of benefits, but we don't want to have to go into massive lifelong debt. So we do have to think about it more proactively. A lot of our students start even in 8th and 9th grade. And some people think, oh, that's way too early, that's putting pressure on the kids. Actually, our goal is for it to be the opposite. We want to kind of lay out for them this peace of mind of, you don't have to be super busy. You don't have to join 20 clubs. You don't have to do all this stuff. There are no scholarships for being busy. I have looked. And so we're not doing that. So we want you to help stand out, but not burn out. And the goal ultimately is to be smart to the best of your abilities and be interesting. Interesting opens doors all day. Then we break down how different colleges make school affordable for them. Some do it only based on family finances. Some do it primarily just based on academic merit scholarships. Some do it a little bit of both. And like state schools don't really do it at all unless there's definite low income, but they can enhance a student's experience through something called the Honors College. So we like to lay out the different kind of almost a matrix of options. And there's great schools at all of those options. And let's consider the family finances, let's consider the student's profile, and let's find the right target to where they can get the best quality education for the least out of pocket and with minimizing loans if possible. Because if we do our job right, they hopefully can get through this without getting saddled with loans. We're a big fan of the 2-year options. They can create great affordability. What I generally encourage people to do is, if we know that the 2-year school is always going to be an option, and that's the nice thing about it, is you're not going to get turned down from going to your local technical school or community college. So in the meantime, though, why don't we go ahead and cast the net wide, do our best application to a range of appropriate 4-year schools, because those scholarships that we were just talking about, the merit scholarships, they primarily only go to incoming freshmen. So what happens is, if a student says, I'm going to go to this 2-year school and then transfer, they could end up paying more for those final 2 years to get their bachelor's degree than they might have paid for all 4 years if they had come in at the front end and gotten a scholarship that would repeat all 4 years. So I'm like, let's not take that off the table prematurely. We know community college is an option, so let's just play what if, so we can make a fully well-informed decision. But where we see the community college classes really starting to play a very strong role is now so many high schools are offering what we call dual enrollment classes instead of, or in addition to, AP classes. And in each case, they both give you college credits while you're still in high school. And so the benefit is kids can come into college as freshmen and still be eligible for all of those freshman scholarships, but they're coming in with almost like a backpack full of college credits that could be equivalent to a year or maybe even a little bit more. So in theory, they could graduate early on the back end and save a year's worth of of funding, or it frees them up to maybe get more credentials accelerated to a master's or do a dual major or something like that. So we really encourage kids to look at the dual enrollment options while they're still in high school, but not necessarily only plan on, I'm going to go to a 2-year school before I transfer, because sometimes that can backfire. So I'm a big fan of, let's respect it, keep it in the mix, but let's not discount the opportunity to go to a 4-year school and maybe get a very affordable option from the get-go.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.